Under Armour will report results on Thursday morning, and to prepare, we're going to run through our usual analysis of comparing management's guidance to consensus estimates in our earnings model. And if you'd like to get management's guidance, it's available in the fourth quarter press release. So you can see in this section down here, they talk about the updated 2016 outlook. So it's a little difficult to read in here, so we're not actually going to refer directly to the press release in our model. We've saved comments with that guidance, so you can see, like for instance, operating income. We show that management guided operating income to $503 million for the full year. So it's just a little bit easier to read it that way. So if you'd like to download this model, it's available on our website, gutenbergresearch.com. You can click on the Models tab, and then from there you just scroll down to the Under Armour model here, and just click the icon, and you can see it downloads right away. And we're also starting this new program where we're allowing our users to repost their own estimates in our models as a professional contributor. So you can sign up, and then you can make basically change the blue cells in our models, repost it with a little blog post explaining your estimates, and share it with your friends on our website. So if you'd like to sign up to do that, just click the contributor tab and do it from here. So with that, we can get started on the model. So let me start by just walking you through some of the basics of our model. First, you can see that we have two different colors of headings. So this dark gray section, those represent historic details, and then the light gray section represent future forecasted periods. Anywhere you see an orange cell, those represent consensus estimates. Purple cells represent company guidance, and the blue cells represent our primary inputs or assumptions. So at the top, we have the income statement. Below that, we have the segment details, so you can see we break it out the same way that the company does. So we have a North America segment, an other foreign countries segment, and then they have the connected fitness segment. Below that, we have a little bit of a breakdown for the revenue by product type, and then we have some basic ratios. We have an analysis of the change in shares, so right now there's no repurchase program. We also made an adjustment for the Class C stock split, which happened earlier this month. We'll talk about that later. And that's about it. And then we just do a quick breakdown of the cash and debt, so we can get a net cash per share, in this case, net debt per share. And our Under Armour model is a Tier 2 model, so we are only doing a multiple valuation. There's no discounted cash flow valuation in this model. So this one's pretty easy to start with. Let's scroll back up to the top. And there's actually one more thing I want to point out with this model. I can actually blow it up a little bit since we're not going to do a split screen. So that might be a little easier to see. So one thing is, I know a lot of you might want to adjust certain product types. So for example, if you looked at footwear, last quarter they had a very strong quarter in footwear. They had the launch of the Curry signature basketball shoes and the Gemini running shoes, and footwear sales were up 95% year over year. So you might want to make some sort of adjustment. But unfortunately in our model, we just show our revenue by product category as sort of like an item of disclosure. So it's not actually driving the income statement. If you look at the revenue line in the income statement and you click in that cell and take a look at that equation, it's just taking the sum of North America revenue plus other foreign country revenue and connected fitness revenue. So it's not doing anything with the product types. And that's because that's how the company reports it. So they're not actually showing all this disaggregated detail. It would make the additional assumptions in a model pretty complex. So this is a relatively simplistic way of doing it. But you can take a look at the North America revenue and say, well, I know that footwear is in that number, and footwear is really one of the growth drivers. And then you could kind of look at the March quarter from last year and say, okay, North America revenue was down 13%. You know, maybe it's not going to be down quite as much as what we have here. So that's the kind of analysis that you can do if you want to include some of the footwear estimates in there. So let's walk through the income statement and let's start. So you can see that we've already calibrated this to meet consensus estimates for the top line revenue and the bottom line EPS estimate. One thing I want to note here is this is the EPS after the Class C stock split. So if you take a look at the share count that management gave us in terms of guidance last quarter, it's obviously going to be about twice what they guided, or exactly twice what they guided, which gets you to this EPS. So if you're looking at something that looks like the consensus is like 4 cents for next quarter instead of 2, then you're probably looking at an analyst who has not adjusted for the stock splits. But it looks like all the analysts have made that adjustment, so the consensus looks good at this point. So now let's take a look at how we got back to these consensus estimates. So that is in our segment details. So if you look at North America, we've got revenue growing at rates that are somewhat consistent with the last couple of quarters from last year. So we always see a dip in March, stabilization in June, and then we see a spike in September, which is what we have here. And then we have another decrease in December. So off that very high revenue base in September. So December still is a very good quarter, but not as good as the third quarter. And then in terms of the operating margin for that region, we kept it somewhat consistent with last year. So the first quarter is a little bit tight. Management did say on the conference call last quarter that the gross margin would be a little tight in the first quarter, and then it would start to recover again later in the year. So we're kind of trying to reflect that, and a lot of that should show up in the North America segment. But overall, we kept the margins and growth rates somewhat constant with what we saw last year. And you can see that these numbers are very exact, and that's because we used the goal seek function in Excel to get back to our estimates up here. So if you take a look at other foreign currencies, other foreign countries, these growth rates are very, very exact, right? So 5%, a little bit less than the first quarter, or pretty, half of what the growth was in the first quarter of last year. And then not quite as big a decline in the second quarter of last year, and then about spot on for the third quarter and for the fourth quarter. So these numbers we plugged in based on these estimates from last year, and then we just backed into these final numbers by using the North America segment. And then connected fitness is not as big of a contributor to overall revenue. So again, we just kind of took some flat growth rates and some flat margin details. We really just took the operating loss that we saw in the fourth quarter of last year and just applied that across the board. But, this is not a huge contributor to overall earnings, so we think that's probably the right approach to take. Below that, well, again, we have the product revenue categories, and if you drill into our equations, you'll see that we just applied the same percentages of total revenue that we saw in the last quarter. So apparel was this percent of total revenue, and then footwear was this percent. So we're just keeping those constant. And again, since these measures are more of just a disclosure in our model, it doesn't really matter. It doesn't impact the income statement up here. And then for the rest of the income statement, we had to use some ratio analysis. So what you see here, this cost of goods sold allocation estimate. So we use a similar allocation to what we saw in the past. And the reason we do that is the management doesn't guide, they guide operating margin. They don't guide gross margin. And they show operating margin by segment. So if you're putting estimates in for operating margin, you've already passed the cost of goods sold section. So by doing operating income, you're already at this row in the income statement. So you've already skipped this row here. So you have to allocate some of that cost to cost of goods sold. And that's what we're doing, that allocation process down here. And that we also kept consistent with last year. Then SG&A. SG&A has remained pretty stable, which is surprising because off a higher revenue base, you would think that it would come down as a percentage of revenue. So their SG&A, given the growth, they still are it's pretty high. It's been 42% for the last 2 years. So we kept it at 42% at this point too. We don't think that there's going to necessarily be a change in that. And that's based on management's guidance as well. Then for the average interest expense, we're just taking the average over the last couple of periods. Let me see here. Oh, no, actually, management gave guidance. So they guided total interest expense to $35 million for the full year of 2016, and we just allocated it evenly across each one of the periods there. So that's where that number came from. And then tax rate, they already gave us the tax rate at 38.5%, so you can see that's in purple as well. And other expenses is not a significant item, so we're just taking about what we saw in the past, so 2.2% of expense there. And that's it. And then we're applying the same change in, about the same change in basic shares and diluted shares. But again, management gave us guidance there. So that's how we got back to our total estimates in our model. And now let's just take a quick look to see where those estimates stand relative to the guidance that management gave. So when we add up the sum of the 4 individual quarters, which meet the consensus estimates, that ends up being $4.96 billion. And on last quarter's call, management gave us guidance of $4.95 billion, so slightly ahead of the revenue estimate. We're also slightly ahead on the operating income line. So management gave us guidance of $503 million, and we had to get to $510 million in order to get back to the consensus EPS estimates. But we're going to talk about that in a second. So slightly ahead of what management guided to. Interest expense we talked about, we just kept that constant at what management gave us guidance for. Provisions for taxes, again, we kept that constant at 38.5% tax rate. And then we've got the share count prior to the Class C split of 223 million. So that's spot on to management's guidance. And obviously, that 2-for-1 split ends up doubling the shares. After this press release, we're going to look at what disclosures the company gives us, because we know that that's not a typical 2-for-1 split. That's actually a new class of share that was issued, Class C, and so we're going to get the details of that. And we're still trying to figure out exactly how we're going to reflect that in our model. But for right now, we just wanted to show the right share count so we can get back to the right EPS number. Okay, so let's talk about the fact that the consensus estimates are slightly ahead of management's guidance. So when we saw this, we were thinking, okay, maybe there's a good reason for why the street is a little bit ahead of what management is estimating. And we put together this quick little analysis that shows how Under Armour's guidance has trended in the past couple of years. So if you look at this is 2014. So this is the first time that they gave guidance for full year 2014 in January of 2014. And they originally guided revenue between 2.84 and 2.87 billion. And if you look at what they did in the next quarter, they raised their guidance. Then the quarter after that, they raised their guidance again. And then the quarter after that, they raised their guidance again. So you can see that the top end of the guidance was the same. But, oh, actually, no. Okay, so 1 raise, 2 raise, then constant, and then they beat their total. And that was on the net revenues. So only 1 quarter that they didn't raise their guidance. But even that, it stayed the same, and then they beat it for the 4th quarter anyhow. Then on the operating income line, it was a similar type of trend. Raise, raise, no change, beat. And that was 2014. And then if you look at 2015, they, from the first time they gave guidance in October, raise, 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 beat. Then operating income, same thing. Raise guidance, raised guidance. Came in at the top end of guidance. So if you're looking at the midpoint, it's raise, 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 beat. So they have a very strong trend of raising their full year guidance every quarter, and then beating their final guidance. So the fact that the street is really only about 7 million ahead of the current guidance from management for operating income at this point early in the year, that might actually end up being a little bit conservative, just given the trends of management raising and beating guidance throughout the year. But of course, we'll have to wait and see. So let's scroll down to the valuation section. So we're basically saying the street is a little bit ahead of management's guidance at this point. So let's look at the valuation. So right now, shares are trading at about $44 a share, and that represents about 72 times the next 12-month consensus EPS estimate, and that's on an ex-cash basis. So in this case, they actually have net debt per share, so we back that out before we do our valuation. So the fact that that's above the 3-month average high point of the forward next 12-month price earnings ratio means that there could be a little bit of valuation risk there heading into the quarter. So I guess what this is showing is that the street has already factored in the fact that management is going to increase their guidance for the next year. So it is a little risky here because if this is the first quarter that management has to reduce their guidance, that would definitely not be a good sign, and it could send shares lower pretty quick. So just keep that in mind. I mean, obviously, if the trend continues and management increases their full year 2016 guidance, then it's going to be business as usual and shares will tick higher. But there is a little bit of risk here, just given where the valuation stands at this point. Be sure to check back after the release. We'll update this model and post it to our models page at gutenbergresearch.com, and you can re-download it with the updated details. And again, you can post your own estimates if you'd like. So good luck with the earnings release, and good luck with the rest of earnings season. Thanks for watching.